So let's dive into the question that's probably been swirling in your mind. What is an ETF? Think about a time when you packed a lunch for school and threw in a mix of different fruits, maybe some apples, bananas, and grapes. Why did you do this? Because you want a variety, right? An ETF works in much the same way. Imagine you have a big basket filled with all sorts of fruit. Each piece of fruit represents a different company's stock or bond. So, if you had an apple, a banana from Banana Nation, and grapes from Grapevine Incorporated, your basket would be like holding shares in those three companies. An ETF is just a fancy way of saying that someone has gathered all these different pieces of fruit, stocks, or bonds into one big basket for you to buy. Instead of picking each piece individually, which could be time-consuming and risky, you can simply purchase the entire basket. The beauty of an ETF is that it's diversified. This means instead of putting all your eggs in one stock, you're spreading them across many different companies. It's like having a slice of fruit pie where every bite gives you a taste of something different. So, when you buy an ETF, what you're really doing is investing in a selection of stocks or bonds that are bundled together. This helps smooth out risk and gives you exposure to the market in general, rather than just one company's performance. So, you've got this idea of a fruit basket that's filled with your favorite fruits. Let's say apples, bananas, strawberries, and blueberries. Now, imagine you want to sell this delicious fruit basket to others, but instead of just selling the individual fruits separately, you package them all together. That way, people can buy one basket and get a taste of all those different fruits. That's exactly how an ETF, exchange-traded fund, works. But instead of fruit, it's stocks or other assets that get bundled together. First, an investment firm identifies the specific group of stocks they want to include in their ETF. They might choose some tech giants like Apple and Microsoft, plus a mix of smaller companies, all packaged into one big basket. Then, just like our fruit vendor, they go out and buy these stocks on behalf of investors. Once they have all the individual stock pieces, they combine them into one big package. This is essentially the creation process of an ETF. The investment firm then lists this ETF on a stock exchange, making it available for public trading. Let's use our fruit basket as an analogy again. Just like you can walk into the market and buy a fresh fruit basket from your vendor, investors can now go to their brokers or directly onto the stock exchange and purchase shares of this newly created ETF. And each share they buy represents part ownership in all those different stocks inside the basket. Once we have our basket full of different fruits and vegetables, let's pretend these are stocks, bonds, and other financial assets. We've got something called an ETF. Now comes the exciting part. How do you actually trade this thing? Imagine you're at a farmer's market where people can buy and sell fresh produce. You walk up to one stall and decide, I want to buy some apples and bananas. You give your money to the vendor who then gives you the fruits you picked. And if you change your mind later, you can go back and sell those fruits for more or less money depending on how much they've grown or shrunk in value. Trading an ETF works almost exactly the same way. Let's say you want to buy an S&P 500 ETF. You approach a broker or use an online trading platform, just like picking your produce at the market. You decide how many shares of this ETF you want to buy. Maybe you're looking for 10 units. The broker checks the current price and then sells you those 10 units in exchange for money from your account. But here's the surprising part. If other people also think the S&P 500 is going up, they might be buying too. So, more demand pushes the price higher. Conversely, if everyone thinks it's going down, the price drops. It's just like how the prices of apples and bananas can change based on supply and demand. And here's another key piece. Because an ETF tracks a basket of stocks or other assets, its value changes in real time as those underlying assets fluctuate. So, if you're looking at your portfolio every hour, you might see slight movements due to the market's changing dynamics. Now that we've traded our ETF, what happens when it's time to sell? You simply head back to the broker or platform and decide how many shares you want to sell, just like returning to the farmer's market stall with some of your fruits. The broker then sells those shares for cash, which goes back into your account. So, trading an ETF is as simple as picking a fruit from a stall on the market. That's it. It's all about buying and selling these bundled baskets of stocks whenever you want to invest or speculate on their performance. And here's the surprising part. Even though you're trading a single ETF, it changes its content to keep up with its underlying assets. Think of it as your fruit basket getting replenished every day with fresh apples and bananas. Let's break this down step by step. Imagine you have an ETF that tracks the performance of the tech sector, like the NASDAQ 100 index. This ETF is essentially a big basket filled with shares from various tech companies. Now, here's where it gets interesting. Every day, the people who manage the ETF are out there checking to make sure your fruit basket still has all the right fruits. If an Apple company's stock in the index increases in value, or if a new tech company is added to the index, the ETF managers will buy more shares of that company and sell some of others to maintain balance. It's like you're at a farmer's market, and every time the vendors come around with fresh produce, they're making sure your basket has everything it needs. They might take away a few old apples and bananas and replace them with new, shiny ones from the latest batch that comes in. So, even though you're buying and selling shares of one ETF, let's call it FO, under the hood, there are constant changes happening. The ETF managers are constantly rebalancing the portfolio to ensure that its makeup remains true to the underlying index it tracks. This process is done to protect your investment from any unexpected changes in the market or additions/removals of companies in the underlying index. So, why do people use ETFs? Let's break it down with something familiar: grocery shopping. Imagine you love apples, bananas, and oranges, but hate spending hours picking each one out of the farmer's market. Instead, you hit up your local supermarket where they already have all those fruits in one convenient place. That's what an ETF is like for investors. It bundles many different assets together so you can easily invest in a lot of things at once. First off, ETFs are super easy to trade. Think about trading stocks as being like buying individual fruits from the market. Every time you want to buy or sell, you have to make that transaction one by one. But with an ETF, it's similar to walking into a grocery store and getting a mix of all those fruits in one bag. No need to pick each one out. Next up is diversification. Most people know the importance of spreading your investments across different assets to reduce risk. With an ETF, you're essentially buying multiple stocks or bonds at once. It's like having a basket with a mix of different fruits instead of just apples. No matter which way the market swings, you won't be affected as much. Finally, ETFs often come with lower fees compared to actively managed mutual funds. Operating an active fund is like having a personal shopper who picks and chooses your fruits based on what's in fashion or trending. They take a cut of that labor. But with an ETF, it's more like a self-serve machine. Take as many fruits as you want without the extra expense. Here's the part most people don't know. ETFs are designed to track their underlying assets very closely. It's almost like having a scale that measures exactly how much of each fruit is in your basket and keeps adjusting to changes in market prices. So why use an ETF? Because it offers convenience, diversification, lower fees, and the efficiency of tracking the overall performance of its portfolio. Just like hitting up the grocery store for all your fruits at once, investing with an ETF makes it easier to build a well-rounded investment portfolio. So, how does an ETF actually work? You might think of it as a big shopping bag filled with different items, where each item represents a piece of stock or bond. An ETF is like the label on that bag, telling you exactly what's inside. Imagine you want to invest in multiple stocks, but don't have the time or knowledge to pick them all individually. That's where an ETF comes in handy. Instead of buying each stock one by one, you can buy this single ETF and gain exposure to a whole bunch of different companies at once. It's like getting a diverse selection of fruits in your grocery bag. No need to choose each one separately. And here's the surprising part. The people who manage the ETF are like magicians. They keep an eye on a market, making sure that what you have inside the bag, or the ETF, always reflects the performance of those underlying assets. So if Apple stock goes up, your piece in this ETF will go up too. Now, let's take a closer look at how it works under the hood. When you buy an ETF, what you're really doing is buying shares of a trust. This trust owns all these different stocks or bonds that are part of the ETF. So when you own one share of an ETF, you're essentially owning a tiny slice of this big basket of assets. And here's another neat detail. ETFs often trade throughout the day, like regular stocks. You don't have to wait until the end of the trading day to see what your investment is worth. Plus, because so many people are buying and selling these shares, the price tends to reflect the true value of the underlying assets much more quickly than a mutual fund might.